All right, let's dive right into this ultimate financial contradiction. Welcome to The Explainer. Today, we're pulling back the curtain on one of the deepest, honestly, most emotionally charged debates in modern investing: gold versus real estate. But hey, we're not just going to stare at dry return rates or dusty historical charts here. No, we're looking at the intense economic anxiety that's actually driving modern investors today. Because the source material we're unpacking reveals something wild. This isn't really a debate about assets at all. It's literally a debate about psychology. It's about how you view the world, how you view the future, and ultimately, how you handle financial fear. So, I want you to take a second to really answer this honestly. Are you trying to grow your wealth, or are you just terrified of losing it? Because the sources point out that pretty much every financial decision you make starts from one of those two emotional states. There's this deep fundamental tension in personal finance between playing offense and playing defense. Think about it. When you log into your brokerage account or when you flip on the evening news and see inflation numbers ticking up, what is your immediate gut reaction? Do you look for an opportunity or do you look for a bunker? Well, that's exactly the core dilemma we're dissecting today. Section 1. Gold, the fear mindset and the psychology of wealth preservation. Okay, so wealth preservation. It's defined by one very specific goal: protecting your existing capital against inflation and market crashes. And it is driven, first and foremost, by a fear of loss rather than a desire for growth. So when we talk about gold in this explainer, we're not just talking about a shiny yellow metal. We are actually talking about a psychological safety blanket. Think about history. Whenever fiat currency starts wobbling, whenever governments print a little too much money, or the stock market takes a nosedive, what do human beings instinctively do? They retreat to gold. And why? Because it's static. It doesn't change. It doesn't rely on some CEO making good decisions, and it literally cannot be digitally erased. It's the ultimate defensive play. But as we're going to see, playing defense comes at a very specific cost. It's an asset chosen out of anxiety, a real hedge against collapse. Moving on to Section 2, real estate, building growth, and the wealth creation mindset. Now, wealth creation, that is an entirely different beast. It's proactive. It involves the strategic use of leverage, taking on calculated risk, and relying on compounding assets to actively multiply your net worth over time. And the key word here is optimism. If gold is a bunker, real estate is a skyscraper. The source material highlights that real estate requires a completely different mental framing. You see, you aren't buying a property because you think the financial system is going to completely collapse tomorrow. You're buying it because you actually believe in the future. You believe people are going to need places to live, cities are going to grow, and values will inevitably rise. You're using leverage, taking on a mortgage, borrowing money to really amplify your returns. You're actively stepping right into risk because you're driven by this dynamic energy and optimism about the decades ahead. Section 3. The investor's mind, fear versus growth. When we pit these two philosophies head to head, the contrast is honestly pretty stark. On one side, the fear mindset of gold is cold, it's static, and it's entirely reactive. You're basically hedging against someone else's failure. You buy it, you lock it in a safe, and you just kind of hope it holds its value while the world burns outside. On the flip side, the growth mindset of real estate is warm, dynamic, and it compounds. It requires active management, tenants, maintenance, community building. It leverages assets to build real long-term value. One mindset is entirely focused on just not losing ground. The other is entirely focused on conquering new territory. To really wrap our heads around this, we have to look at how time plays into it. Imagine the psychological life cycle of an economic crisis. So, year one, there's a huge shock. Inflation spikes, maybe the market crashes, panic naturally sets in. The fear mindset totally takes over, and capital flees straight into the static safety of gold. And hey, gold shoots up in value because, well, everyone is terrified. But then, let's jump to year 5. The dust starts to settle. Central banks manage to stabilize inflation, the panic subsides, and then, by year 10, something absolutely massive happens. The compounding gap becomes visible. The investor who hid in gold, they have roughly the exact same purchasing power they started with. But the investor who stayed the course in real estate, their tenants paid down their mortgage, the property appreciated, and their initial investment has compounded in a huge way. Which brings us to Section 4, the long-term consequences. What happens over decades? All right, so here is the ultimate reality check. Think about the preserved value of gold. It adjusts for inflation, sure. I mean, an ounce of gold bought a really nice suit in 1920, and an ounce of gold still buys a nice suit today. It essentially keeps you perfectly treading water. But now, Consider the compounded growth of real estate. Because you used leverage, say maybe putting 20% down to control 100% of the asset, and because that property cash flowed while simultaneously appreciating, the growth becomes exponential. The gap between these two strategies over, say, 20 or 30 years, it isn't just a few measly percentage points. No, it is literally the difference between retiring comfortably and creating true generational wealth. And that brilliantly illustrates the core limitation we've kind of been circling this whole time. You cannot shrink your way to massive wealth. Let that sink in. If your entire financial strategy is based on defensive maneuvers, hiding from inflation, and avoiding absolutely all risk, you are never going to experience exponential growth. Sure, fear-based investing guarantees you won't fall below a certain floor, but it simultaneously builds a solid concrete ceiling right above your head. To achieve outsized returns, you absolutely have to be willing to expose yourself to the dynamic mechanisms of growth. Section 5. The final verdict. Which strategy builds real wealth today? So let's consolidate everything we've unpacked in this explainer. Look, we're not here to say one asset is inherently evil and the other is some magic pill. They both serve incredibly distinct functions. Gold's primary function is to preserve, and its underlying psychological driver is fear. Real estate's primary function is to multiply, and its psychological driver is growth. Now, if you already have an established fortune of, let's say, $50 million, and you just want to ensure your great-grandchildren aren't wiped out by hyperinflation, then a vault of gold makes perfect sense. But if you're trying to build that fortune from scratch, well, you need a multiplier. You need an asset driven by the mechanics of growth. It really all comes down to this. Wealth preservation survives the storm, but wealth creation builds the empire. A storm shelter is a wonderful, necessary thing to have when a tornado touches down. But you can't live your entire life huddled in a dark basement just waiting for the wind to blow. At some point, you've got to step outside, take a calculated risk, lace some bricks, and actually build the city. Gold keeps you alive, real estate, and the growth mindset it fully represents allows you to thrive. Which brings us right back to the most important part of this whole explainer. You. I want you to take a hard look at your own portfolio right now. Are the assets you own a reflection of your optimism for the future, or are they monuments to your anxiety? Ultimately, are you playing to win, or are you just playing not to lose?